index for growth is 61%. There are some companies, for instance, Meristem, I'm going to Meristem, that has a growth index, and that index is in about 19% today, right? So growth means you are buying companies that have a runway, a larger runway to grow. They are highly priced, but their appreciation is very, very fast. As regards growth, the other end is going to be value stocks. A value stock is more of a mature stock, right? The stock's already matured. We don't think it's going to grow more. So what does that stock do? It just pays you a lot of dividends. So when you have a mature stock, that stock is not really growing as fast, but it's paying you a lot of dividends. So you have the growth and you have the value. Growth index for Nigeria is about 61%. If you invested in just growth stocks, 61%. But let's get down into the actual like sectors in Nigeria we can actually look at. Banking is in about 17.28%. Banking. So if you just invested in all the banking stocks in Nigeria, the good ones, the bad ones, the ones that have done capitalization, the ones that are still doing capitalization, you would be on about 17.28%, right? What about insurance? Insurance last year was the flavor of the stock market. Huge returns because we're going to pass this Insurance Act. And if you look at the Insurance Act and the Tax Act, they're asking mandatory insurance. And they're also asking that if you do insurance, you can also cut your taxes. So now you see a lot of firms have come to the market. A lot of investors have chased those firms to the market. So insurance stocks in 2025 were very, very hot. This year, not so much. This year, they are doing about insurance, it's about 9.86% so far, right? That's what we are. But then if you take a look at the oil and gas index last year was a bit, I would say a bit flat. This year, and just to walk back, if you look at the last year, the GDP growth last year, the bulk of Nigeria's GDP growth last year has come from the crude oil sector. So what the president has done that was very, very, like what he did was to go back to this oil sector, this crude oil sector that we say we want to diversify away from. He is maximizing the opportunities in that market. So you hear Shell coming back, you hear Seplat, you hear all this noise in the oil and gas market. And that oil and gas market is now booming, right? So if you just bought the oil and gas stocks, the stocks in that oil and gas in the index, you'd be up about 40% year to date as we speak, about 40% year to date as we speak. So that's a very, very big jump for you. And Nigeria is being driven by investments, by the earnings that the oil index is bringing back to Nigeria. And that's what is reflective in the stock market that we're seeing. The last one I also want to mention is the ethical index. Ethical index means in Nigeria, there are some folks that want to invest ethically, which means they don't want to earn interest when they invest. So they're not going to do banking. They want to do mostly manufacturing like Dangote Cement. They want to earn interest or riba, stuff like that. That's also a very, very growing sector in Nigerian stock market. We're about 28%. If you look at that market as a whole, 28%. And if you did the Lotus fund, you'll be up about 28%. But one thing again, you have to look at the market in total is that the market is not when we say invest in America, you always hear me say sometimes saying go and buy the index in America, because when you buy the index in America, you sort of get a representation of the Magnificent Seven, i.e. the Alphabet, the Amazon, the Google, the Tesla, those guys that drive the market. Once you buy the index, you are overexposed to them, right? Nigeria is not so much like that. In Nigeria, there are specific stocks that move the market. So if you simply just buy the index, you might not get that full exposure. Or if you are in a particular index, you might not be capturing the growth that is happening in a smaller index, but with a major player. I give you an example. The best stock last year, if you look at the price appreciation last year, was NCR. NCR went up at 1,000% or something like that. But you don't see it represented in terms of the market capitalization, right, of Nigerian Stock Exchange. It's not a big player in terms of the market cap in Nigeria. It's not an MTN, it's not a Dangote, it's not a BUA, but it was the highest performing stock in Nigeria. What's the second performing stock? ASO Savings was one of the highest performers, but ASO Savings is delisted now, right? So the stock in Nigeria can go up, but it's not reflective of the actual market cap or the sectors that are actually performing well in Nigeria. What that tells us that Nigeria is a market where you have to be very, very tactical. You've got to know what particular stocks and what particular sectors you want to play in. You could say, oh, oil and gas index is doing 40%. So I'm going to buy oil and gas index. There's some dead stocks in that index. And there's one or two stocks that are driving that index. The same thing, you're going to say, oh, wow, Dangote is in the consumer goods index. It's also in the industrial index. So I'm going to buy the industrial index because there's Dangote, there's BUA. So those sectors are driving the economy. Hence, I want to be in that sector. Industrials are doing about 17%. They're just meeting the market. They're not really beating the market per se, but they're meeting the market. But those are the high cap stocks in Nigeria. And those are, again, the point is you've got to be rather tactical when you are dealing in the Nigerian stock market, right? You've got to know which ones are going up, which ones are going down. That's why I brought my guest in here today, and I hope he's going to join us pretty soon. He has, I think I can share their handle on Twitter. They do this weekly recommendations of stocks to buy, stocks to sell. Again, they're a stockbroking firm. They have their license. It's their recommendations. So I always look at those recommendations as if I do my research, I look at the research and say, is it jiving? Is it agreeing before you take investment decisions? That way, so it's corroborating what you think you already want to buy. If you want to also give them the funds to invest, I'm sure they would think in Nigeria, right? I don't know if you guys have informed the news last week. There was a news article I saw that sort of made me think. The article was talking about the Nigerian ETFs and Nigerian mutual funds. So a mutual fund or an ETF is a bit that is buying individual stocks. So if I have, for instance, the banking index or the banking mutual fund or the banking ETF, I would then go and buy all the banking stocks and put in that index. So just by mathematics, it means that the index itself reflects the individual stocks that are bought, right? The index should reflect the individual stocks that are bought. So yes, there might be plus or minus 5%. Maybe somebody's trying to buy the index and not buy the individual stock. There'll be plus and 5%. But there shouldn't be a 50% gap between what's in the index and what are the individual stocks are doing. So again, if you want to follow, I just shared the report, the weekly report for the NGX on Twitter. If you want, you can go back there and see it. But just talk around this controversy about the index and the constituents. There shouldn't be that much daylight between what the index is performing and what the market is performing. So when you are seeing a lot of growth in the index, but not a lot of growth in the individual stocks, it represents, should we say, a bubble. Because what's happening is that the foreign portfolio investments are coming in through the index. They might not have the time to then buy the individual stocks. They are coming through the index. So the index is going up in price, but the individual constituent units should also go up in price. It shouldn't be that disconnect, if you understand what I mean. If I'm buying 5 banks and those 5 banks go up in price by 10%, we should see a 10, 15% growth in the index, but we shouldn't see a 50% growth in the index without 50% or 40% growth in individual stocks. So I think we'll get, usually, either the individual stocks will then mirror what the index is doing, or the index would mirror what the individual stocks are doing. But ultimately, there has to be sort of not 100% convergence, but the trend has got to move in the same direction, if you know what I mean, right? Fantastic. Let's talk about ETFs in Nigeria. We have a lot. I'm going to share the link again with you. I usually prefer mutual funds and ETFs to buying individual stocks, especially for most of us on this space that might not have the time or the resources to do the individual purchases. So if you want to buy all the banking stocks, and you'd have to have a lot of money to buy literally all those stocks, right? But if you bought the ETFs, for instance, you could say, okay, I'm just going to buy the banking ETF, or I'm going to buy the the top the top 30 stocks in the Nigerian stock market. If I buy the top 30 stocks, I'm able to represent what the entire market is. So essentially, those two give you a representation. Like if I can buy a sector, or I can buy just the top highly capped stocks in Nigeria by just buying the ETF. And once you do that, then you have gotten exposure. It's the same for Nigeria, it's the same for the US. Buying the index is a cheaper way to diversify, to spread your risks, and to get exposure immediately. But in Nigeria, again, I'm just giving you this scenario. In Nigeria, if you look at the ETFs, don't really do a lot. People are going to say, what's an ETF? What's a mutual fund? Almost the same thing, guys. The ETF just means it is tradable during the day. Mutual fund just means you have to wait till the end of the day to get the price. But the ETF is tradable during the day. So if it's tradable, you can buy that mutual fund and sell it during the day. But a mutual fund, you have to wait till the day is over to buy. Okay. So abroad, in America especially, the ETFs are very liquid and give you a tax consideration as well, which means if you buy those ETFs, you have a tax consideration, just like in Nigeria, where if you buy the collective scheme and you get a dividend from the collective scheme, you don't pay tax on dividend. So if you don't know this, if you bought the individual stock or you bought the collective scheme, if you get a dividend from the collective scheme, you won't pay taxes because they've already taxed the collective scheme, just putting that out there. But in Nigeria, the volume of the ETFs are not as much as the mutual funds. So again, you want to also look at volume in Nigeria. Many times you see a stock going up in price in Nigeria, but there's no corresponding volume following that price movement. So you get in and you can't get out. You get in at 10 naira, the price goes to 50 naira, but you can't get out at 50 naira because there's no one that's going to take you out of the market, right? So you are sort of like the volume in Nigeria is as much as important as the price. If you're buying the stock, you've got to make sure you look not just at the price you're buying, which is you're saying, oh, I'm buying at a quote unquote cheap price, but what is the volume being traded? If the volume is falling, you shouldn't be in that stock, right? Because you can buy that stock and not be able to get out. So always peek at the volume. What's the peak volume for last week? What's the volume this week? What's the volume for the whole year? And how you have a sense, you don't want to be the one buying rice in the market when everybody's buying beans. It makes no sense because when you buy that rice, people have moved on to beans. You can't sell your beans. So you have the rice, your rice is worth a lot of money, but it's paper money. You can't sell it. So if you want to buy, you want to make sure that you are also looking at the volume, not just the price in Nigeria. So the point again I'm making before our guest comes, Nigeria is a very, very tactical market. It's difficult to buy and hold because sectors change. Number two, Nigeria is a market where the ETFs do not really reflect or with the individual stocks. So sometimes you can build your own individual stock portfolio, or sometimes you can go with the collective scheme portfolio, but be aware of what you're doing. And the telling I just explained to you now, right? The volume in Nigeria is a key factor in your trades because with your volumes, you are able to say, am I buying this falling knife or am I buying a rising star? So falling knife means the price is falling. You think you are buying a cheap stock, but you are buying a stock that is already falling. So it will cut your hand. A rising star means that you are buying a stock, even if it's expensive, but that stock is going up. Yeah? Fantastic. All right. So my guest, I'm just going to send him a link. He just sent me a text. Give me a second and I'll send that link. So if you guys have a question, you can. He's going to hop in here real quick. and I will let him to speak, and you guys can. Okay, yeah, he says he'll be here in 5 minutes. Fantastic. So yeah, so yes, fantastic. All right, again, and one last thing I want to talk about. Last week, I did share a template for you, especially if you're a younger Nigerian. And I said, this is how you want to trade the market, both the foreign markets, both the Nigerian market. I shared the template for you, how you want to trade. Why young? Why young Nigerian? Why not all Nigerians? Unfortunately, guys, if you are older, you are approaching the market at a slight disadvantage. What do I mean? When you look at the calculation of compound interest, if you look at it carefully, if you go to your bank, you tell your bank, I want to invest in a million naira. They're going to tell you, okay, we're going to pay you interest of 5%. What does that 5% really mean? If you go and you disassemble that 5% interest rate, you will find out that it is based on time, not on amount. Time, not on amount. If you go to Google and you say, Google, give me the formula for compound interest, you're going to see it's going to be present value 1 plus parenthesis, bracket, parenthesis open, interest, parenthesis close, raised to the power time. Time. If you invest earlier, you make more money. So trick question, trick question. If I invest 1,000 naira 10 years ago and then go to invest 1 million naira after 10 years, and we both are investing for 20 years. So I invest 10 years ago, I invest 1,000 naira, then go to invest 10 years after me, invest a million naira. Who will have more money at the end of 20 years? When people see this question, they're going to say, well, I invested 1,000, Dangote invested 1 million. He's going to have more money than me. That's wrong. Make more money than my 1,000. People say, wait, he's going to make 1.5 million. Yes, that's his return on his 1 million. But the return on my 1,000 is always going to be more than the return on his 1 million. Why? Because time, compounding works with time. So when you buy equities, when you buy shares, you are riding on this thing that Albert Einstein called the eighth wonder of the world. You are compounding. So if I buy a bank today, and I get my interest and I put the interest or the dividends back into the bank, I have compounded because I've taken the return, the dividends the bank gave me, bought more shares, I have compounded. Compounding does two things. Number one, it increases my ownership. Number two, it reduces my purchasing power, my cost. The purchase price I bought it drops it. So if I'm a younger person, if I'm 25 years old and I'm buying, take my 1,000 naira and I buy a share in Nigeria. By just compounding, i.e., just waiting, taking my dividends, putting it back in the stock, and just allowing that stock to keep on going 10 years, 20 years, I make more money than you that are putting more money. Remember, you are putting more money, but your percentage compounding is lower because you have a shorter time. Compounding works with time. So the strategy for you in the stock market is the dividends. Go to sleep. It's that simple. It's literally that simple. Who is the best stock investor the world has ever seen? Warren Buffett. What does Warren Buffett do? He buys a company, he takes the cash from that company and buys another company. He takes the cash from that company, he buys another company. He only sells when he has fully maximized the cash flow from that company or when he believes the company is overpriced or technology is going to come. He doesn't buy and sell every day or every year. He bought Apple, he just sold Apple 2 years ago at a huge profit because it was a big part of his portfolio. So we've got to copy what works. If you are younger, number one, you want to go buy an equity, not bond, equity mutual fund. So it can be an index fund, it can be an ETF fund, but it's got to be equity. What is equity? Profit and loss. So you are going to ride the profits of Dangote, of BUA, of Seplat, of UBA, of Zenith Bank, whoever it is. You want to ride the profits and losses, because as they are going up, you are going up. If you buy debt, you are guaranteed that they will pay you back. So if you buy a bond, you are guaranteed that Dangote will pay you back, but you are not riding the growth of Dangote. So if Dangote Refinery comes out today and says, I want to borrow from you, it's going to issue you a bond. If you buy that bond, you are going to get your money back from Dangote, guaranteed. But if Dangote makes times X return, you will not make times X return. You will only get your dividend or your coupon from Dangote. But if Dangote Refinery sells equities tomorrow and you buy equities tomorrow, then you are riding the profit and the losses of Dangote Refinery. That's number one. So you are earning. Then when Dangote Refinery pays you a dividend, you take that dividend and you put it back into to buy more Dangote shares, or to put it back into your portfolio, your equity portfolio. You are compounding. Compounding is a verb. You've got to do something. You have to take the dividend and put it back. So number one, you go buy an equity fund or an index fund. Number two, when you earn dividends, which means you've got to earn dividends. When you earn that dividend, you plow it back to your portfolio. So you want to ask them, in America, they have what is called DRIP, D-R-I-P, dividend reinvestment plans. Most stocks have a DRIP. So when you buy, you tell them, set me up on DRIP. So you wouldn't get any dividends. The dividends go back to buying you more fractional shares of that security. So every time you buy a new fractional share, what have you done? You've increased your holdings, you've reduced your average cost. So even if the stock price goes down, you are reducing your average cost. So your portfolio is still in the positive. You are no longer looking at the market price. You are looking at your own average price. This is the trick people don't see. If you buy a stock at 10 naira and you reinvest the 1 naira dividend, you have reduced your average price from, say, 10 to 9. So even if the stock price stays at 10, every time you reinvest your dividends, you are reducing your average cost. So even if the stock price is stuck at 10, you are making a paper profit. That's the compounding Einstein is talking about, the reinvesting of the interest. So when you see this tweet, I saw this tweet a long time ago, 4 years ago, where a guy said his father bought a bank stock and he went back to the bank and the bank says, oh, after 10 years, this is what you own. His father only made about 100,000 naira. And he said, stocks. He said, no. I said, no, you're getting it all wrong. If you reinvest all the dividends your father had earned on that bank stock from when he bought it, you don't use the market price anymore. You use the average price, which would have fallen because you have reinvested all those dividends. So if the market price is 10, your father's average cost is now 1. So you've made 9 naira profit, which anyone that is buying today does not have. That's why this strategy works with age, not with amount. So when you start early, you buy your equity fund. Equity fund. Number 2, you invest in that equity fund with low expenses. Number 3, you reinvest your dividends. That's all. Number 4, you go to sleep. You don't look at it. Leave it alone. It's an equity fund. So that means if the stock today crashes, the manager would sell the bad stock and buy you a new stock. If you buy, for instance, the VOO, and a particular stock is no longer doing well, Robinhood is now in VTI. So they keep on replacing them. If you don't do well, they kick you off. If you are doing well, they bring you on. The oil companies before were all part of the top Dow 30. Now only Exxon is there. Why they've kicked the others off. They're not keeping pace with Tesla. Tesla 10 years ago was nowhere. Today, Tesla's market capitalization is more than the market cap of Toyota, Mercedes, BM, Volvo combined. If you combine the market cap of Toyota, Mercedes, BM, Volvo, all those companies combined, Tesla is bigger than them by market cap. Your manager would buy Tesla into your equity fund. You don't have to do anything. You don't have the time. You don't have the knowledge. That's why this strategy works with time. Does it mean if you are older, you can't do it? You can, but you've lost the advantage of compounding. The older you get, the longer you wait, the more you are losing the value of compounding. Younger people today are more guaranteed, in quote, to make money than you when you get older. But when you get older, you have the money, but you have no time. When you're younger, you have time, you have no money. There's a song that says, youth is wasted on the young. That's true. So if you are 25, don't say, when I make money, I will invest. You've got to start investing yesterday. Buy an equity fund, like I said, 60-40. I said 60 US, 40% non-US. Non-US can be Nigeria. Non-US can be South Korea. But do your 60, do your 40, reinvest your dividends, and simply wait. You don't know enough to trade. Have that portfolio, have it going. In 10 years, you are going to be so shocked what you would have made. Today, we're hearing gold has gone up in price. We hear Bitcoin has gone up in price. No asset class has beaten the return of US stock market since 1928. So if you compound what the United States stock market has done from 1928, even with the crash, the Great Recession crash that happened, you will find very few, if any, if there's going to be any, it might be Bitcoin, but that's just how many years that has beaten the return of that market. So if you know that market's a guaranteed market, you want to have exposure to that market. My guest is here. I'm going to just add him real quick so he can speak. Mr. Tunde, you want to request to speak as well? Then he can speak, and then he can sort of walk us through. We want to go deep into the market now. What stocks? People want to hear what stocks. They've got their pens. I got your DMs, but I want Mr. Tunde to give those because he's a broker. He's licensed, so he can basically give you that information, and it's part of what he does. So once he's able to add himself to the space to speak, we will have him introduce himself, and then we can get going. Next week, we're going to have to bring someone here. We're going to talk in detail about this compounding strategy. I'll give you the stock, the ETFs you can buy locally and foreign. I'll give them to you. I'll tell you how. It's not theory. I'll tell you how you can do it. So thank you, Mr. Tunde. Welcome, sir, to the space. So we're talking the NGX, which stocks to invest in today and tomorrow. How are you doing, sir?
Yes, Carlo, thank you for having me. I'm great. And good evening, everybody. And thank you for joining this space. I hope you can hear me loud and clear.
Loud and clear, not a problem, sir. Yes, sir.
Okay, thank you so much.
Yes, sir. Let's just go into maybe introduce yourself and after Stevens. I already gave a brief into like I use.
All right, thank you so much. Carlo, my name is Tunde Amolegbe. Managing Director, CEO of Arthur Steven Asset Management. We are a firm licensed as broker-dealer by the Securities and Exchange Commission of Nigeria. We are also a trading license holder of the NGX, that is Nigerian Stock Exchange. Outside the Nigerian Stock Exchange, we also trade on other exchanges in Nigeria. We trade on the NASD OTC market, that is over-the-counter market for unquoted stocks. We trade on FMDQ OTC market, which is the market basically for fixed income assets such as bonds and treasury bills and the likes. And then we also trade on FX commodity exchange, the market that trades in commodities such as agricultural products, rice and coal. And we trade also on the Lagos Commodities and Futures Exchange, which trades in gold and cocoa and other commodities such as. So we have presence in all the exchange, all the 5 exchanges that are trading platforms in Nigeria.
Fantastic. I mean, so we can do everything with you guys. Thanks for that.
Absolutely.
Let's get into it real quick. So let's do top down. In terms of the Nigerian economy, what's your prognosis of the economy today? Where are we today? We hear the economy has stabilized. What does that mean to a trader or an investor?
What it means is that you will have to in doing an analysis of the economy, you need to look at some basic indices. It's like analyzing someone that is sick. When you are sick, the doctor will come in and take your vitals and say, okay, look, what's the temperature of this person? What is the blood pressure level and the likes? It's the same way when you are analyzing an economy, you have got to look at some basic macroeconomic indices to be able to determine the health of an economy. So some of the basic macroeconomic indices we look at is, for instance, the GDP level. All right, is it rising or is it falling? Is it rising at the rate it should be rising? You look at inflation levels. Is inflation rising? Is it falling and the likes? You look at exchange rates, FX rates. Is your currency strengthening or is it weakening and the likes? You look at all these various indices to be able to determine the strength of an economy and also its direction. All right. So when you look at it in the last few years, what we've seen is significant instability in some of these indices. For instance, our GDP growth rate, we've been doing a growth rate of about 1.2 to 1.4%, while comparable economies were probably doing something like 3-4%. All right, so that and what GDP growth rate means is the aggregate of products and services produced in our economy, which means that if we are only growing by 1.2%, we're actually not growing. We're actually not doing a lot of production. Of course, every devaluation or is it depreciation of the naira, coming from something like 480 naira to $1 to something close to 1,900 to $1. All right, in the last few years, so affects the economy. And of course, the exchange rate coupled with other issues also led to very, very high inflation rate. Our inflation rate went from something like 9% to something close to 32%. All right. So all of that pointed to an economy that was in trouble. All right. That was in trouble. So, but what in the last, I would say 1 year, that due to a few factors, what we are seeing was a stabilization, if you will, of the economy. I.e., we saw a situation where exchange rate wasn't depreciating as fast as it was. So exchange rate that had been 1,900 is now something like 1,000. So trend downward, and then we saw GDP of the country growing from 1.4%. Fully start to expect growth. All right, because typically when you are in a hole, you have got to dig yourself out of that hole first before you can now start talking of climbing. So I would assume that we're probably out of the hole at the moment, and then we're going to have to look at how we need to climb.
Okay.
So that That's just a prognosis for now.
I like how you said we where we're supposed to be, and then we then grow. So if the question is, will the stock market reflect that growth, or will the stock market
is different from what is really happening? There's a big difference between what Wall Street is saying compared to what we are seeing on the main street. So it's a forward indicating market. A lot of the policy into trouble to buy it at 800 naira. It hurts everybody's pocket. All right. So, but while the stock market recognizes at 200 naira for us to buy it at that level, those 4 or 5 trillion naira will now hopefully be channeled into something else. Hopefully channeled into something that is positive for the economy. That is the way the stock market is reading it. Now, typically, the stock market will not wait until that aspiration actually comes through to stocks.
I see.
All right. So the stock market assumes that 4 trillion will end up in something productive, maybe increase in infrastructure and all of that, and that those increases in infrastructure will be positive for the companies operating within the economy. And so it will price those and when that does not happen, then the market also have the capacity or the mechanism. But for now, the assumption is that all right.
All right. So what we're looking at is the market is looking at 2028, 2029, but
right.
we are in 2026, more or less. Okay. So let's come into the market now. So if I had to invest, let's start with the sector. Give me 3 sectors. I don't know if I should make myself a 25-year-old and I make myself a 50-year-old. If you want to do 2 of them, but a brand new investor, I'm 25 years old. How should I approach the market in terms of the sector? And if you want to do that also for a 50-year-old, do it once. That's your call. But give me the sector first before we now go to the stocks in that sector.
Okay, so for a 20 capital expansion, you can afford you are going to be facing a lot of expenses in the future. You are probably going to be of say 10 million naira. The expectation is that 70-75% of that should go into stock. All right. At the moment in Nigeria, all right, you should in the consumer goods sector. If we are going to become sector, so consumer goods sector. So we are talking of the likes of Nestle Food. We are talking of the likes of demand is essentially inelastic because we have a large population. All right, a large population of young people, and these guys are producing things that people cannot do without. All right, I mean people will have to use McLean. Not McLean. I mean, and simply because of our population is so large, all right, and you have to buy those stuff to such a sector, consumer goods sector. Number 2, you also want to have exposure to the industrial sector. So when we say industrial, we're talking of the likes of the cement companies of this world. All right, we're talking of the construction companies of this world. Because Nigeria is a developing, it's not even a developing country. It's still not there. All right. So if you look at our budget, a significant portion of capital expenditure means that government is focused on building bridges, building roads, building dams and stuff like that. All right. And that is not likely to change anytime soon. All right. So if government money is directed towards that sector, then your investment should also be directed towards that sector, because for the foreseeable future, million, you probably want to put maybe like 60% of that in fixed income securities and 40% in equities, that is stocks. All right, the fixed income ensures that you are able to get a regular income coming in form of interest or whatever you want to call it. All right, and then the equities give you an hedge against inflation. All right, so for someone like that, you want to put money in. So the dividend you get also. All right, so you want to be in banking regular dividend. Yeah, so that's
so how the fixed income was how much?
5-year-old, you want to go between 50 and 60% in fixed income. All right. Then go between 50 and 40% in equities.
Okay. We have CPs. We have which ones?
Right. So fixed income are debt securities. They are essentially loans made to governments and made to corporates, all right, that have been securitized, that have become in form of securities that you can buy. So we're talking of bonds.
Mm-hmm.
Bonds are long-term borrowings by governments or corporates. And what we mean by long-term borrowing is that the repayment period is beyond 1 year.
Mm-hmm.
Or a government, for instance, can say,